Welcome to Introduction to Business. We're going to be looking at the final chapter, Chapter 16, Financial Management and Securities Markets. Our learning objectives include describe some of the common methods of managing current assets, identify some sources of short-term financing, also known as current liabilities, summarize the importance of long-term assets and capital budgeting, specify how companies finance their operations and manage fixed assets with long-term liabilities, particularly bonds. Explain how corporations can use equity financing by issuing stock through investment bankers. Describe the various security markets in the United States. Current assets include cash, investments, accounts receivable, and inventory. Current liabilities are short-term debts obligations, accounts payable, wage payable, tax payable, and notes or loans payable. Current and short-term assets are often used interchangeably. Short-term financial management is sometimes called working capital management because current assets and liabilities continually flow or work through the organization. The goal of financial managers who manage current assets is to maximize the return on those assets. Effective cash flow is the movement of money through an organization. It is a crucial element in facing any financial manager. Transaction balances are cash kept on hand by a business to pay normal daily business expenses. To accelerate the collection of payments from customers, companies may have customers send payments to a lockbox, an address for receiving payments that are collected by the bank and credited to the business's account. The bank can then start clearing the checks and get the money to the company's checking account much more quickly than if the payments had been submitted directly to the company. Larger firms may use electronic fund transfer to speed up collections and cash flow. Companies generally want to collect cash quickly, but pay it out slowly. When companies use electronic funds transfer between buyers and suppliers, the speed of collection and distribution increases to 1 day. When cash comes in faster than it is needed to pay bills, companies may invest extra cash for short periods. Marketable securities are temporary investments of extra cash for up to 1 year in the U.S. Treasury bill, certificates of deposit, commercial paper, and the euro-dollar loans. U.S. Treasury bills, also known as T-bills, are short-term debt obligations of the U.S. government. They are issued weekly. These bills carry maturities of between 1 week to 1 year. They are considered risk-free because the U.S. government will not default on its debt. Commercial certificates of deposit, also known as CDs, are issued by commercial banks and brokerage firms. They are available in minimum amounts of $100,000 and may be traded prior to maturity. Commercial paper is a written promise from one company to another to pay a specific amount of money. Because commercial paper is backed only by the name and the reputation of the issuing company, sales of commercial paper are restricted to only the largest and most financially stable companies. During recession, nobody wanted to rely on commercial paper, requiring the Fed to take action. The euro-dollar market is the market for trading U.S. dollars in foreign countries. Investors have a chance to earn slightly higher rates of return with just a little more risk than the U.S. Treasury bill. Each credit sale represents an account receivable, which is a payment owed to a business from the credited customers. Many firms offer discounts on purchases if they pay the invoice early. Discounts make cash flow through the firm faster, but also reduce profitability. Profitability is the accounts receivable is affected by the type of customer to which the business extends credit. Information on company credit rating is provided by the credit bureau, credit rating agencies such as Dun & Bradstreet, and industry trade groups. The object is to minimize the firm's investment in inventory without experiencing production cutbacks. As a result of critical materials shortfalls or lost sales due to insufficient finished goods inventories. Optimal inventory levels are determined in part by the method of production. RFID tags are becoming a popular way of companies to manage their inventory. Because customers may switch to competitors when needs are not met, inventory shortages can be as much of a drag on potential profits as much as too much inventory. Accounts payable is money an organization owes to suppliers for goods and services. Trade credit is the most widely used and important source of short-term financing. It's credit extended by suppliers for the purchase of their goods and services. Most suppliers offer trade discounts to businesses that pay their bills early. Failure to take such discounts can add up to substantial loss. A bank provides both large and small businesses short-term funds in the form of loans or lines of credit. A line of credit is an arrangement by which the bank agrees to lend a specified amount of money to the organization upon request, provided that the bank has the required funds to make the loan. Secured loans are backed by collateral that the bank can claim if the borrower does not repay the loan. Unsecured loans are backed only by the borrower's good reputation and the previous credit rating. The principal is the amount of money a business borrows. Interest is a percentage of the principal that the bank charges for use of the money it loans. The prime rate is the interest rate banks charge their best customers for short-term loans. Insurance companies, pension funds, money markets, funds, and other financial institutions also make short-term loans to businesses. Some companies sell their accounts receivable to finance company called a factor, which gives the selling organization cash and assumes responsibility for collecting the accounts. Additional non-bank liabilities must be efficiently managed to ensure maximum profitability are taxed, owed to the government, wages owed to the employees. Long-term fixed assets are those assets expected to last for many years, such as plants and equipment. Leasing is one approach for companies who do not have the funds to purchase expensive buildings or equipment. A capital lease is a long-term contract and shows up on the balance sheet as an asset and a liability. An operating lease is a short-term cancelable lease that does not show up on the balance sheet. Capital budgeting is the process of analyzing the needs of the business and selecting the assets that will minimize its value. The capital budget is the amount of money budgeted for investment in long-term assets. It does not end with selection, purchase, and the use of assets. All assets and projects must be continually reevaluated to ensure they remain compatible with the firm's needs. Budgeting is not an exact process, and managers must be flexible when new information is available. Every investment carries some risk, with international investments carrying more risk. You must consider economic and political climate, stability and competitive nature of the market. Pharmaceutical companies face many risks with new projects. They spend millions of dollars developing new drugs without knowing if the drug will pass FDA approval. Dramatic changes in the marketplace are unknown. Long-duration projects or assets are riskier. The longer project or asset is expected to last, the greater its potential risk becomes because it's difficult to predict how long it will last before it wears out or becomes obsolete. Buying rather than repairing new machinery is riskier. There is a limited supply of funds available for investment. The returns on any project must be covered not only the cost of operating the project, but also the interest expenses for the debt used to finance its operation. The most common, efficient, and profitability companies can attract the lowest cost funds because they have a reputation for less risk. Insufficient and high cost companies must pay high costs to attract suppliers of funds. New companies have a strong motivator to use financial resources wisely because they will over time reduce the cost of their funds and increase profits. New firms tend to enter industries with the greatest reward for success. competition intensifies and drives down profit potential. Two ways of financing to acquire fixed assets include equity financing and debt financing. Long-term liabilities are debts that will be repaid over a number of years, such as long-term loans and bonds issues. Financing with long-term liabilities is a type of debt financing. Many firms acquire debt by borrowing money from pension funds, mutual funds, or life insurance funds. Companies that rely too heavily on debt can get into difficulty should the economy falter. A bond is a debt instrument that a company sells to raise long-term funds. Bonds are issued by corporations, public utilities, nonprofit corporations, and federal, state, and local governments. Most bonds can be transferred from one owner to another in a bond market. The bond contract or indenture sets forth all terms of an agreement between the lender and the bond issuer, including the face value, which is the initial value of the bond, the maturity date, the date the bond owner receives the face value of the bond, along with the final interest payment. The coupon rate is the guaranteed percentage of face value the company will pay to the bond owner every year. In other important areas such as repayment methods, interest repayment dates, procedures to follow in case failure to make payments, conditions for early repayment, and any collateral conditions. Unsecured bonds are debentures or bonds not backed by specific collateral. Secured bonds are bonds in which the issuing company pledges specific assets to bondholders as a guarantee should it be unable to make interest and principal payments. Serial bonds are a sequence of small bonds issued to progressively larger maturity. Floating rate bonds have coupon rates that change with current interest rates. A junk bond offers high rates of return than other bonds, but a higher risk because of greater likelihood of default. Owner's equity is the owner's investment in an organization. Sole proprietors and partners own all or part of the businesses outright. Their equity includes the money and assets they have brought into their ventures. Common stock, the single most important source of capital for most new companies. It represents the ownership in a corporation that gives the stock owners voting rights. The par value is the dollar value of a stock printed on the stock certificate. The market value is the current market price of the common stock, and the difference between the stock's par value and its offering price is called capital in excess of par. Preferred stock gives owners preference in distribution of the company's profit, but not voting privilege. The primary advantage of owning preferred stock is that it is a safer investment than common stock. When a company has profits left over after paying expenses and taxes, it can retain some or all of the earnings to invest in corporate expansion or payout of some earnings in stockholders in the form of dividends. Retained earnings are retained and reinvested into the assets of the firm. They belong to the owners and in the form of equity. When the board of directors distributes some of the company's profits to the owners, it issues them cash payouts called dividends. A dividend yield is the dividend per share divided by the stock price. Not all companies pay dividends. A payout ratio is the percentage of earnings paid to the stockholders in dividends. A company that needs more money may be able to obtain financing by issuing stock. When a company issues stock for the first time, it's called a new issue. A company that offers its stock to the public for the very first time is said to be going public, and the sale is called initial public offering. New issues are sold directly to the public and to the institutes through primary markets, the market which firms raise financial capital. The secondary markets are stock exchange where investors trade their securities with other investors rather than the company that issued the stock bonds. Investment banking is the sale of stocks and bonds for corporations. Investment bankers can help iron out the details in mergers by helping the firms come up with appropriate price. Security markets provide the mechanism for buying and selling securities. Liquidity is the ability to turn the securities into cash. Secondary markets permit the trading of previous issued securities. Secondary markets trade may take place on organized exchange or in what is known as over-the-counter markets. Formerly, exchanges were divided into organized exchanges and over-the-counter markets. The New York Stock Exchange and Nasdaq are publicly traded companies. Previously were not-for-profit organizations. Both exchanges merged with electronic exchanges for cheaper and faster trading than floor trading. Nasdaq was traditionally an electronic market. The over-the-counter market is a network of dealers all over the country linked by computers, telephones, and teletype machines. Mostly consists of penny stocks, other small stocks, and illiquid bank stocks. Nasdaq is no longer considered an over-the-counter market because it is now classified as an exchange. There are a variety of averages and indexes available for comparison purposes. An index compares current stock prices with those in a specified base period. An average is an average of certain stock prices. Many investors follow the activity of the Dow Jones Industrial Average to see whether the stock market has gone up or down. 30 companies currently make up the Dow. Recognizing financial bubbles can be difficult in an enthusiastic atmosphere of rising markets. The most recent recession was partly precipitated by a cash of housing bubble. The Dow Jones Industrial Average gained 10 times from August 1982 to the beginning of 2000. This was the internet bubble, and they are difficult to see unless they burst. Before the housing bubble burst in October 2007, the Dow Jones hit an all-time high. The Federal Reserve and the federal government acted quickly to bail out failing institutes, starving off the potential worst recession. Investors must be well informed to make sound financial decisions. Thank you so much for listening to this lecture, and I also want to thank you for taking my course. Thank you for participating in the class and being a wonderful class to engage with. If you do have any questions about the content, please email me. If you have any questions about your grades, please also reach out to me as well. Thank you.